Hello everyone, welcome back to the session. Previous session we had looked at what is a collective investment scheme, and we also had looked at who is a investment manager or a fund manager. Now in this session we will look at different types of different types of collective investment scheme. We will start with first the very famous mutual funds. The mutual fund is a collective investment scheme. Typically, how it actually works is there is a fund manager or an investment manager who pools the fund across from various investors and they invest in the market. They generate the return. This return is passed back to the investors. Now, let's look at with the example like how a mutual fund actually works. Now, let's say for example, I have a mutual fund called as a ABC mutual fund. Now, this ABC mutual fund are launching in the market with a capital of, let's say, for example, $100 million. So, they are starting with $100 million of capital. Now, how the mutual fund will do is this $100 million will be divided into equal units. Okay, let's divide it into equal units. Now, let's say, for example, that they're divided into equal units of 10 million units. Now, this one unit is one quotient, or the 10 million units, one unit is actually one part of mutual fund. Now, how the investors will actually do. Now, let's say when the fund launches, right, each unit they will fix a price. That is actually called as a NAV, NAV of a fund. Now, let's say for example that NAV is $10. Now, how the investments will happen is there are investors. Now, let's say for example there is a investor A. So, what investor A does is he buy one unit of mutual fund. He buys one unit of mutual fund, and we call this process as subscription. Subscription in the fund world means that buying of units. So, he will buy one unit and the investor A will pay $10. He will pay $10. Similarly, what a mutual fund does is they collect the investments across from thousands and millions of investors. So, these investments are pooled together, they invest in the market. Now, let's say for example, ABC mutual fund have collected $100 million and they are investing in the market. So, let's see how the investments will work. Now, out of this 100 million, let's assume that 50 million they are investing in equity shares of different companies. So, let's say for example, they invest in Apple Inc. equity, they invest in Meta Inc. Like that, different types of companies, they invest about like 50% of that money is invested in equity shares. The remaining 50 million are invested in the fixed income. Let's say for example, fixed income, when we say fixed income instruments like for example, bonds, treasury bills. So, they invest this money. What happens is the mutual fund over a period of time, it will generate the return when there is an increase in the value. Let's say after 1 year, the mutual fund becomes 120 million in total value. Now, 120 million is the total value of the fund after 1 year. Now, if you see, we started with 100 million and after 1 year, the total value of the fund is now 120 million. That means the fund have earned a return of 20 million. The fund has earned a return of 20 million. This 20 million will be passed back to the investors in the form. It will be passed back to the investors. Now, what will happen is when the investors bought the fund, it was valued about like $10. Now, after 1 year, the NAV of the fund will become $12. Now, some of the investors who actually invested will want to redeem. In a sense, they want to liquidate their holding. So, what will happen is they will redeem the funds. When I say redemption is a process where the investors will return. So, redemption can also be told as a selling. So, what will happen is the investors will now sell back this 20, they will sell back the units which is now $12. So, investor A in this case, he started with $10 and after 1 year, the value of the fund is now $12. He sold and thus he made a profit of $2 million. So, $2. This is how a mutual fund actually works. Okay. So, we have just looked at how a mutual fund actually works. Now let's look at what are the different types of mutual fund. Now there are different if I want to classify the mutual fund based on the first classification is based on the structure of mutual fund. We can classify the mutual fund into open-ended fund and closed-ended fund. Now there are basically three characters or three features based on which we classify the fund into open-ended and closed-ended. First one, it is capital. A open-ended fund has a variable capital, means when I say capital, right, number of the capital of the fund or the number of units will increase or decrease. So whenever a mutual fund issues the units, the value of the capital will increase, and whenever they buy back the units, the capital of the mutual fund will decrease. So our open-ended fund will have a variable capital and depending on the number of units issued or redeemed. While when we compare to a closed-ended fund, the closed-ended fund has a fixed capital. Means let's say a fund opens at the year 2021 and is operated till 2030. Throughout this period of 10 years, the capital of the mutual fund will remain fixed. Second important thing is how the buying and selling, that is how the subscription and redemption of mutual fund works. In case of open-ended fund, the investors buy the mutual fund or sell back the mutual fund units directly with the mutual fund company. Whereas in a closed-ended fund, it works like a stock or a bond. Like after the initial period, it gets listed in the market, in the stock exchanges, and the investors between them will buy and sell the mutual fund units. The third important thing is liquidity. In case of open-ended fund, it is highly liquid due to the variable capital nature, and the closed-ended funds will have a low liquidity. So these, based on the structure, we can divide the we can classify the mutual funds as an open-ended fund and a closed-ended fund. Now second thing, based on the investments, what the mutual funds do, the mutual funds also can be classified as equity funds, debt funds, or a balanced or hybrid funds. Now, equity funds are those mutual funds which invest predominantly in the equities, like they invest in equities and indexes. Second one is a debt fund. This debt fund, what they do, they invest in the fixed income securities like bonds, treasury bills, etc. And there are third type of funds which is called balanced or hybrid, which invest in both equities and fixed income. So based on the investments done, a mutual fund can be classified as a equity fund, debt fund, or a balanced fund. So that's about like types of mutual funds. Last thing, we look at how the structure of mutual fund is looked. So basically every mutual fund follows a three-tier structure. The first one is a sponsorer. Now sponsorer is an entity which actually creates or establishes a mutual fund, and they provide the initial capital, or also known as a seed capital. Then we have a trustee. The trustee is an entity which takes care of managing the fund. They are responsible for compliance, and they also need to make sure that the investors interested in the mutual funds are protected. Third, we have asset management company, or called as a AMC. Now AMC takes care of all the asset allocation and investment decision. Apart from sponsorer, trustee, and AMC, we also have a couple of entities which helps in running or managing a mutual fund. Those are one, transfer agent. Basically the transfer agents manage the bookkeeping for a mutual funds, and we have a custodians, and the custodians, they do safekeeping of assets for the mutual funds. So this is the structure of a mutual fund. Thanks for your time.